Financial markets are inherently complex, and all financial markets are interdependent and intercorrelated. In news today, the collapse of Silicon Valley Bank and Signature Bank calls the Fed interest rate path into question. The Fed is literally caught between a rock and a hard place. Increases in the federal funds rate have caused massive pressure on businesses and collapses in the banking sector. In fact, in the aftermath of Silicon Valley Bank, $465 billion in the global banking system was wiped out. One thing that we see in financial markets, markets can move very, very quickly. Michael Burry just recently tweeted, "This crisis could resolve very quickly. I'm not seeing true danger here." Yet others are saying Silicon Valley Bank isn't a Lehman moment, but it could be a Bear Stearns one. Bear Stearns failed in March 2008, 6 months before the collapse of Lehman Brothers ushered in the global financial crisis. We've just seen also the release of the CPI month-on-month, year-on-year, and core CPI month-on-month. CPI month-on-month came in as forecasted. So did CPI year-on-year. But core CPI, what they're actually looking at, came in hotter than anticipated. We're going to look into internal market structure to see what this actually all means, but the stocks did climb after the CPI report. Silicon Valley Bank has thrown an absolute spanner into the economic works. You must be really careful about news headlines. Look at the forecast and look at the actual. Forecast and actual. CPI month on month, the same. CPI year on year, the same. Forecast 0.4% for core CPI, actual 0.5%. This is coming in hotter than anticipated. So when news commentators say that it's coming in lower, they're using the previous. Just be aware of these factors. US inflation cooled in February as the Fed confronts bank failures. Remember, the forecast was 6% and the actual was 6%. It came in as anticipated. It's good that we're seeing a reduction in the CPI. You can see overall, CPI measures are coming down more than what the core CPI. The core CPI is quite sticky. And why is that? It's core services creating a bit of a problem. Core goods have come down. The core CPI is coming down, but core services inflation is going up. So what does the Fed do? It's stuck between a rock and a hard place. The Fed, if it increases the federal funds rate, could potentially crack the economic system. If they don't increase the federal funds rate, people are going to think that it's a Fed pivot and they're going to go crazy, which would drive inflation higher. We can see right now that there's a 77.5% chance of a 25 basis point increase and a 22.5% chance that everything stays the same. And don't forget, the next FOMC meeting is in 7 days. The markets are holding onto a concept that the Fed is going to pivot, and it's going to pivot by just not increasing rates. After all, how could it with this bank collapse? Following this, we can see some upward movement in junk bonds and high-yield corporate bonds, bringing risk back into the market, and we can see the markets have responded positively to that. Yields have come up as bond prices have come down, and the VIX came down as well. There's a lot to look at here. There's many things that we need to be aware of. One thing to note is oil is starting to collapse. That's not a good sign. We can see also that the dollar has been decreasing and gold has hit some kind of technical resistance, and it's just coming down, just slightly. We'll look into that as well. One thing that we must bear in mind is the helicopter view. When we look at the S&P 500 and we go back and we map all the sell-offs and recoveries in the S&P 500 since 1966, we can see that we're in a fairly good momentum. We've overcome a level of resistance. We're just pulling back, but actually, are we? Have we done a crossover? Have we done a cross under? Are we losing support or bouncing from support? That is the critical question. That is actually the million-dollar question at the moment. One thing that you will find, if the S&P 500 starts to come down, everything will come down with it. Of course, we may get some pockets where gold rallies and the DXY rallies and the VIX rallies, all of those things we look for. But I'm talking about stocks and also, of course, crypto. And that's where the majority of people have their money. What do we actually see here from a technical perspective? We can see the January to March peak. And if we actually draw a resistance line down through there, we see that the markets actually came up over that resistance, but they failed to turn it to support. They've actually confirmed that we're still in a downtrend. We haven't been able to break that positive or that negative momentum with a positive move. That's from a high level resistance. What about this lower level resistance? The resistance within a resistance. What we actually see is the S&P 500 got above that, tried to test a support level, failed, retested, resumed down. It's bounced from this technical area. But does this mean that the markets are healthy? Please let me know in the comments. Is that a sign of a healthy market, or is that a sign of a market ready to sell down? What about the last time it did this? What about the last time it came through support, broke it, retested, and resumed down? You can see the follow through there, and it can be quite ugly. Recently, we did a deep dive investigation into the 2008 financial crisis, 08-09, and what we saw is we could be at two different spots, either here, point A, where we've just lost support, came back, retested. Note this positive price momentum. It even got more positive as it tried to retest this line. This is really important to zoom out sometimes. If you get caught in the day-to-day, you'll just be whipsawed out of positions because you don't have a longer-term time frame to actually look at things through. Notice this weakening negative air appearing. We'll be watching for that. And when we had, finally, the Washington Mutual Bank, which was the largest bank failure in history, occur inside the US, there was a flurry of positive action taken by the government, but that just didn't stop anything because there were too many things that were weighing on the financial market. But even so, look at all this up and down action. We actually look at the market through a trading perspective, and when you trade, you can make money all the time basically because you're just seeking to get on the right side of the percentage. And of course, the important thing to note, if you're an investor, when it comes to the markets always recover. But do you want to be sitting there waiting years for a recovery, or do you want to be exercising your other superpower, which is trading? It's really important for investors to know trading, and also very important for traders to know investing. There's no requirement to be one or the other. It's not an exclusive club. In fact, you already have membership to both clubs because of Rule 138. All investors become traders every time they buy or sell. And the same can be said with traders. They become investors as well. So don't narrowly define yourself. When we had all of this financial turbulence inside financial markets, you can see that there was a raft of policy actions and other policy actions and market events. This is to be expected, and we've got our eye open for it. President Biden recently came out and said everything is fine and then walked off stage. The government is assuring that depositors will be made whole. I've been in the financial markets for more than 3 decades, and one thing I've noticed, they all say the same things around the same time. Just be a little bit mindful. That's why we have Rule 252, prepared and not scared. What you look at is if there are very substantial storm clouds gathering on the horizon, just pack an umbrella, but just keep on trucking on, keep on being in the market because you need to be. Always bear in mind what we're actually doing from a technical perspective. We have had a cut under. Price has a negative momentum currently. What is actually going on here? We've lost our support, but we've bounced after very negative momentum. This bounce is turning the markets positive. And you can see that quite clearly here. All sectors in the main markets over the past 24 hours turn positive, but be aware of where we are. We know that sharp angles reflect. That's another rule from inside the masterclass. We also know that price is always moving in a wave. It's always going down and up. You just only need to get onto the right side of the percentage. And especially in crypto, because crypto is very, very volatile, and the crypto industry is very optimistic by nature. The fear gauge of the main market, the VIX, was in the process of turning around, and you can see just how spiky the VIX can get. I love trading the VIX because it's a basket case basically. When it spikes, it really spikes. But you've got to be careful. When it falls, it can collapse. You can trade the VIX through CFDs. When we look at the objective dynamic market structure inside gold, because we've marked up this chart from 1883, we can see that gold is above a key level of support. It's just trying to consolidate all of these recent gains, and it's doing it on the right side. We wouldn't want gold to be consolidating down here or under here. So far, gold is looking good, but it's very dependent on what the DXY does. If the DXY starts to spike, we would anticipate losing this support level and at least coming back to the 1870. Or if the DXY continues to fade, we would expect gold to come up to at least the 1936 level, if not above, around the 1960 level. Please let me know in the comments, which way do you think gold will go? The DXY is currently 103,662, and you can see it's pretty much smack bang on the bottom of a smart money buy area. That smart money buy area is between 103,643 and 103,957. One thing to always be aware of when it comes to the CTKS method, these particular zones are actually created through all of price action, and price tends to ping pong between one level and another. If there's a gap between levels, what typically happens is that if we lose a key structural level in short-term perspective, we can have a massive drop down. And that's what we saw quite recently, but it can go the other way as well. If we get over a key short-term resistance, it can just spike into that area. If it doesn't have the strength to get through, it will be repelled down to the lower level. Keep this in mind. There's another smart money buy area in the DXY from 102,914 to 103,226. Keep this one on your radar. We've done our process because we need to look at the most risk-on or risk-off asset there is, and that is Bitcoin. We can see that when the inflation CPI data actually came out, we saw a rally. Now we're seeing a sell down. And where did it rally to? It rallied to a smart money sell level at around the 25,888 level. 23,965 is the next smart money buy level, and you can see that we have a few there and a lot more support around the 23,213 mark. But if we lose that, we're probably going to revisit around the 20,600. But always bear in mind your three-dimensional thinking. Also, it's critically important to keep in mind where the S&P 500 actually is. And where is that? You can see that it's actually under support, and because it's under support, we could anticipate more negative flow through. But always be aware of the three-dimensional nature of price. We move with price action at all times. How do we actually do that? By understanding the market controls the returns, we can only control the trade or investment. We always assume that the market will move in the opposite direction to where we wish it to go. That doesn't mean we don't participate. That means we're mindful. We're not gambling. We've assessed the probabilities. We've stacked them. Also remember, in financial markets, it can take weeks, if not months, for things to play out. That's also something that's often overlooked. Patience is very, very important. When looking at financial markets and stacking probabilities, you're trying to increase your synchronization factor. Why is that? Because the market exists to transfer money from the desynchronized to the synchronized. A lot of people, when they get into financial markets, enter Zone 1 and Zone 2. This is where they want to ride every single wave, buy at the bottom and sell at the top. With the trade I shared yesterday, I was showing you that you can actually do much better if you just move inside the trade itself, move inside its own price action. In Zone 1 and Zone 2, people can do a lot of things. They can count trades that they never made. In Zone 3 and Zone 4, we don't do that. We err on the side of caution. Why do we do that? Because we've been in markets long enough to know that the markets can turn on us in a heartbeat. Market structure is currently weakening. Does this mean that this weakness will eventuate in a greater weakness? Perhaps, perhaps not. How then do we get certainty on where things are going? We need to know where objective dynamic market structure actually is. And we know Bitcoin cannot escape the stock market's gravity, and no alt can escape Bitcoin's gravity. That's why we must look at the stock market. To figure out where price action can go, the only thing we can do is to observe price action as it unfolds. The S&P 500 has an absolute raft of smart money buy levels in here. We need to figure out if it can get above this 39.35 mark. It's currently 39.20, so it's heading in the right direction. But if it actually fails to get out of this molasses here and it gets repelled down, because either the Fed increases interest rates, and don't forget the next FOMC meeting is in less than a week. But what if we go the other way? What if we get a breakout above here? Well, then the party is back on. It's critical to keep your eye on price action each and every day. We're doing a deep dive today into the main markets because we need to understand where Bitcoin could potentially go. And where Bitcoin goes, the market also goes. We are literally at a make or break point inside the market cycle. We can see that retail sales month on month and the PPI month on month is coming out soon, as well as building permits and then later on consumer sentiment, followed by the next FOMC meeting. Pay very close attention to the Stanfield zones as they're playing out inside market structure. Always have your three-dimensional thinking, your plan, right up in front of your nose at any time. If there's a major sell-off, what will you do? If the markets just consolidate for the next month, what will you do? And if the markets explode upwards, what will you do? You should have an answer at all times for all three questions. And that answer can only come from you. Every single investor and trader has different priorities and has a different focus. They also have different amounts of money that they're putting into the market. If you're putting in a substantial amount of money into the market, you will have a different risk management strategy than those people who are putting in hobby amounts of money. Always bear Rule 252 in mind. Prepared and not scared. Be prepared to participate when price action gives you a clear direction. If price action is not giving you a clear direction or you feel desynchronized from the market, you can just sit on the sidelines until you feel synchronized again. But how do you get synchronized? You start small and scale. Never ever run away from the markets. It's a mistake. Because at the time you run back into the markets, you'll be buying pretty much at the top. It's something to bear in mind. I spent a lot of time on the main markets because of Rule 225. Bitcoin cannot escape the stock market's gravity. You can see that the S&P 500 has clearly done a cut under. Even though the market momentum could be a little bit positive at the moment, it's not out of the woods yet. And how do we know it's out of the woods? We observe price action. Make all your decisions based on price action and none of them based on fear. If you miss opportunities, that's fine because there's always other opportunities. What you will find, the more that you are in financial markets, the more years that pass, you become very, very protective of your portfolio. Seasoned traders and investors are much more cautious than new traders and investors. And why is that? Because they've been burned. But one thing, they don't stick to any position apart from observing price action. If price action heals, they're in with both feet. If it decays, they're out and waiting to get onto the right side of the percentage. And don't forget, always have patience. Things take time in financial markets. Financial markets are incredibly frustrating. That's why we focus on positive excellence. We're learning machines. We simply tinker with our particular strategy. Things take time to unfold in financial markets, and they take time to unfold in life. For example, if you got a new job and you do a fantastic amount of work, you would say, "Where's my promotion? I want my promotion." But patience is required because the boss is looking if you can handle sticking it out. What happens when you start a new weight loss plan? You have your goal, you want to lose X, but after the first week, you've lost nothing. What do? Do you give up? Or do you have positive excellence and have patience? What about when you say, "I'm going to get really, really fit," and you buy all the great stuff to go to gym and look fantastic in gym, and then you go for a week and you say, this is all too hard. I don't look like Arnold Schwarzenegger now. Well, no, after a week you're going to take a bit of time to get there. You'll require patience. So what do some people do? Of course, they take steroids. Taking steroids will absolutely just pile the muscle on, but it will cause a lot of health complications. And what about when people get into the markets? Oh, I'm going to be rich. I'm going to go all in and more, and also I'm going to leverage. Patience is obviously incredibly important. It is a superpower to have. And what about if you wanted to take up a new skill? You've looked at it for a day or two, you've seen 5 YouTube videos on it, you still don't understand it. Time to give up. Or is it time to have patience? That's why positive excellence is just a life-changing thing. To have determination, to have patience, to have humility, to have persistence and commitment. All of these things, even one of these things, can change your life for the better. The concept of patience is very, very important to talk about. I'm very much looking forward to your comments. Keeping positive is vitally important. That's why we do daily positive affirmations for abundance, financial success, and happiness through the CTKS Creed, which is, I know the universe is designed to make me succeed. Every day I show kindness, integrity, and gratitude. I know opportunities and life reset daily. I am worthy. I go slow to go fast. I start small and scale with Borsog. Life pullbacks give me the strength for the next life rally. I am dedicated and committed. I win or learn and never blame. I always solve my problems with positive excellence. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.